Welcome to How I Met My Broker
by Strategic Brokers,
where we uncover the stories, strategies and insights of individuals who've built significant wealth
through smart leverage.
Get ready to learn, be inspired and take your property game to the next level.
Well, g'day everyone, it's Liam Garman here, co-host of the How I Met My Broker podcast. And today we've got a cracker of an episode. I am joined by some pretty smart cookies who are going to take me through how you can identify a growth area, especially as we're in a pretty uncertain time. Interest rates are fluctuating, the cost of living is growing. So if you want to invest, you're going to have to invest smart and buy into those areas where they're going to do the heavy lifting for you. And I'm joined, as always, by my amazing co-founder, Chuy from Strategic Brokers. Mate, few weeks out of country. Welcome back. I think you're about 24 hours back into Australia.
Mate, I'm not even 2 hours since I've returned, and I've literally got off the flight and went home, had a shower, came straight into the recording studio today.
And that shows how much you want to keep Aussie investors informed. Now, we're joined by, as promised, two amazing guests, Matt Djolic, CEO of HtAG, and Michael Lezaja from Pinnacle Buyers Agents. Gentlemen, welcome to the studio. I think it's the first time I've met the both of you. Kick us off. Give us a little bit of background about HtAG and Pinnacle Buyers Agents. We'll start off with Matt.
Okay, thanks for inviting us, by the way. HtAG, we started 10 years ago. Essentially, we deal with data analysis mainly. That's our wedge, essentially just trying to connect data points and analyze, and predict market movements. So we're going down the subscription path, but we also have like enterprises clients and stuff because we're sort of focusing on that accuracy of the prediction, and mainly sort of service buyers agents and investors. Most of our subscribers are buyers agents and our members are buyers agents. But I guess, elevator pitch would be, really nailing that accuracy when it comes to, what's moving, why is it moving? The why is very important. And that's what we focus on,
And Pinnacle?
Well, buyers agents, as the name suggests. This is my 12th year as a buyers agent. And we just help everyday Australians purchase properties in good areas, data set areas, and the usual where we can, off market, the majority, under market value. Is getting a little bit more difficult, but I'm going to talk about it later on how we sort of source those off market and under market values for everyone. But that's pretty much what we do.
So the theme today is there's a little bit of uncertainty in the market. So we want investors to keep identifying those growth areas. And we're going to be leaving them with some tips and tricks to identify them and analyze those data points to make sure that they're ahead of the curve. But as we start off every How I Met My Broker podcast, how did the three of you meet? Take us away.
Usual spiel, throw fire emojis in the inboxes and then slowly like a photo from 10 years ago, a couple of rockets come into the sky.
Well, this is a really recurring theme. It's just DMing people on Instagram. You've never DM'd me on Instagram.
I did.
Oh.
You gotta get one. You get one after this.
I don't want
send you one.
But I just asked for it. I don't want it now.
How you doing?
No, I was just joking about that one. I think the actual truth is I met Michael from a mutual client of ours who was on about the 10th property, I believe. And I think he'd done a segment on one of his podcasts about this particular client. Obviously, I'm in the fortunate position to be able to see the portfolio grow. And as clients are switching buyers agents, I get to see the locations they're buying in. And I noticed Michael's buying in a lot of new markets, which other people weren't buying in yet, which caught my interest. And I'm like, hey, you've got to introduce me to your buyer's agent. And then you believe it or not, one text message, this guy calls me straight away. He's such an old school buyer's agent. There's no, I get to my admin, then get to my assistant, then get to someone else. And then I can talk to him. Mate, picked up the phone, called me straight away. And we just banged on and we got on like a house on fire. So it was a pretty natural, I guess, transition. And then he introduced me to Matt. Then it kind of rolled in hand, and Matt's invited me over to his masterclass. We're hosting a webinar next week, I believe. So people,
Wednesday, 25th.
If they listen to the show, if it's released prior to that, if you get the chance to tune in, it'll be a really good chance to hear about both myself and HtAG running together on that webinar, I guess. So
I love it. It's such a recurring theme on this podcast where it's to be in the driver's seat like you, seeing all of the mortgage applications come through and saying, crap, good. Okay, introduce me to your buyer's agent. Who got this? It seems like you're just passing all of that information to see who the people overperforming in the industry are.
Yeah, so that's why this show, I guess, was created. I guess we're in the centerpiece of seeing a lot of data points, as you could imagine. and I see what I like and see what I don't like. So I invite guests on the show, which I think are doing great things in the industry and really helping the buyers out there. So yeah, as our two guests are on today.
So Matt, Michael, it's a big thing. Everyone's always looking for the secret sauce. What's the Da Vinci Code behind investing? I think it's very fair to say that between the two of you, you are very data centric. I mean, of course, HtAG is literally about the data, right? What are the most important data points? I'm going to throw this open to the both of you when investors or buyers agents select a growth market.
Yeah, I'll start. So I think that's a bit of it's a difficult question to answer because data points shift in importance and significance on the basis of the individual brief. So you'll be looking at a completely different hierarchy of importance of data points if your brief is to sell within 3 years as opposed to selling in 10 years. So it shifts on the basis of what you're trying to do. So that's the most important thing. And I think investors need to understand that, you can't have a blanket view of every data point and assign the same value to all of it. Because what you're doing there is you're averaging result for your particular circumstance, and your particular circumstance drives decision making. Now, in saying that, there are certain aspects that you consider mostly across every briefs, and I divide them sort of in essentials, supply, and then market momentum. I think essentials, you got to address, essentially risk elements of the area. And risk elements are usually related to the volatility aspect of things. And of course, that relates back to long-term investment time horizon. So industry diversification, exposure to negative environmental effects, data confidence, what is the velocity of sales in the area historically. One of the most important drivers, especially in the current landscape, is the affordability. There's a very high correlation between affordability and price growth. So that's essentially a fundamental aspect that you start with first. And then I would say socioeconomics, because pairing socioeconomics with affordability gives you that fundamental base of initial growth as well as long-term steam, what I call. And then I think the second stage will be supply. A lot of people, when they start investing, they approach growth from the demand side of the equation. And I always say that demand can be manufactured. Like we can all agree, put our clients into a single area and it will grow in value. So I think you first in research, any form of research that you do, you got to address things that you can't control. And this is the supply. The government controls the supply. You and I control it. I don't know when you're going to sell your asset. You don't know when I will, essentially. So if you restrict the supply across multiple time frames, short-term, mid-term, and long-term, you have that supply scarcity restricted across those multiple time frames, which in combination with affordability and URSA gives you that long-term steam. So that's essentially the starting point. But usually when we analyze areas, we end up analyzing for each individual brief about 50 to 60 data points at minimum, I would say, yeah.
Now, I know a lot of buyers agents use HtAG as quite an important tool. It's also available for just regular everyday investors that want to have a crack at it themselves. Take us through, what does it look like? How can you use it? What are some of the aspects of the tool that make it very useful?
There's a couple of domains of our service. So there's like I would say a static way, dynamic, and then there's a coaching aspect of it. Static way would just be the platform or the SaaS. You subscribe, you essentially, filter metrics, and you find the best areas. Now, the whole filtering process and the methodology we teach, it's sort of rigorous in a sense that it follows a step-by-step process, which is why we also have a mastermind community where we coach members on how to layer data and information. I always say it's one thing to see figures on a page and yet another thing to understand the story that they tell. So you need to connect all of the data points into a story. And a lot of people assume that data is this, abstract thing that sits separate to behavior. Data is a reflection of behavior. So when you connect the data points into a relationship, you understand the behavior on the ground and what is happening. So coming back to investors, they would subscribe, they get integrated into Mastermind. We have a selection of mini courses where they would actually learn the methodology. And there's a dynamic way as well. We built our own AI agents as well, where they're essentially based on the why. So they have 5 decades of data, all of our reasoning, and it will explain to the user as to why that's the best choice for their particular brief. So it's very essentially detailed and complex in a sense that it breaks everything down and it tells them what to look out for, where the friction points are, et cetera, et cetera. So there's a variety of ways how investors can essentially approach it. Buyers agents, on the other hand, have, I would say, more features, more support. They get access to really detailed statistical analysis research on a monthly basis, which drives the decision making. So there's a bit of an extra domain or extra level that buyers agents will get, I would say.
And as a buyer's agent, What are some of your secret codes in finding a growth area? And I know Matt mentioned there's a story behind it. You've got to put the data into a story. Maybe this is where the buyer's agent comes in. Is that gut feeling? Is that just what the feeling is on the ground? Can you explain that?
Definitely. A lot of gut feel. Back before HtAG was invented, there was a lot of that. And the strategy that I used was mostly trying to buy everything under market value. So I'd try and buy, back in the day, a $300,000 property for $220,000.
That's a great strategy.
It always works, right?
It always works.
Because you're always ahead.
Yeah.
Try and spend, the particular one I'm referring to is a townhouse in Macquarie Fields. And we'd spend $6,000 on it, and that would be coat of paint, flooring, new vanity, reseal the shower, rent it out for $380 a week. These are the good old days, really, where you can get an 8.4% yield on something for $220,000. You extract the equity, go again, and that's how I did the 14 in 12, right? But those times, because you had to guarantee actually each deal was going to get you to the next one. It wasn't so much waiting for the market to move. Now we look at data, and there's amazing things like HtAG out there where you can look at data sets now and know where the next spot is if you're very, very good at analyzing the data. And fortunately, we've been working with HtAG quite a while, and we use the platform, of course. It doesn't steer us wrong.
And it comes down to the, compounding good decision making, I always say. So, you nail the data side, then you nail, under market value side, and you get the initial burst as well as the momentum. And if you can do that, then it really reshapes the portfolio building process.
100%. And the under market thing, that was so easy back in the day, because you as a buyer's agent could call someone and go, I'm a buyer's agent. And they're like, oh, are you? Do you have buyers? And that was the market that had supply. So it was a totally different time. So you could say, yeah, I've got buyers. All of a sudden, you're on a pedestal. The agent loves you. Right now, you call an agent. Like, what do you want? Oh, another buyer's agent, So the times have changed. So you don't necessarily need to now go out and do what I did or what we used to do back in the day. You can go out now based on, analyzing the data correctly, picking a spot that's about to take off. No one knows it yet, and just buy at market value, and it kicks off, and you enjoy the cycle. Like you ride it all the way up. So it's like just getting into the right asset and then spending that little bit on it. I love the the best bang for buck things you can do are paint and flooring. And you call Carpet Court, you get your hybrid floor put in, you get the property manager's local contact for a handyman, coat of paint, $15K spend. There's your little bit of an uplift. Get top dollar for rent, and off you go. And
that strategy, that kind of glam up, does that still work?
Yeah, we're using that now. Yeah, where we can find the under market value, we will 100%, and we're chasing that. But they're just a lot harder to get with the amount of buyers agents now actively looking. It's not like 10 years ago. It's a lot harder. The world's a lot smaller.
Yeah, I remember when someone first gave me the advice of, whenever you speak to an agent, ask if they've got any off markets. And I thought I was the biggest gangster. It's like, you walk up to, hey, do you have any off markets? I'm like, I'm the coolest person ever. Yeah. But now this is a question that Hung has put in front of me to ask. All three of you boys are from the area.
Okay.
What are your thoughts about housing commission and the effects of price growth in those areas? Hung, do you want to kick us off with that question?
Yeah, well, maybe I'll put my own personal experience into that. And obviously, growing up, I grew up in an area called St. John's Park. Next door was Bonnyrigg. Bonnyrigg was a suburb which was completely housing commission. And then, I watched the prices in those areas start from when my dad moved in, maybe $170,000 to $1 million today. So, the effects of the suburb of Bonnyrigg there being, complete housing commission, it kind of crippled a little bit the market for a long time. So there would have been better opportunities elsewhere. But then when I looked at the percentage growth versus surrounding areas or going to affluent areas, I looked at it and we got 6-7 times the money, right, in a shorter span of time. That being said, if you could forecast ahead that Bonnyrigg was going to get wiped out and they're going to build all brand new houses there, then you were, holy crap, you're ahead of the curve. So, your data points also then point around the yield curve. There's so many suburbs surrounding that actually were presenting much better data sets if we had data back then, right, that you could have bought into that didn't have to be directly in the housing commission or what we might call a no-go zone, which is there's pockets of no-go zones. And that's something which data can't really show it sometimes, but when you're out on the street and you just walk past a shithole, you'll see, mate, this is a shithole, and you're scared for your life walking past it. It'll probably bring me to the next stage, which I was actually looking at I was living in an area called Miller for 4.5 years. And
I went to Miller High School.
you went to Miller High School. There you go. Miller Tech, they call it. They have these satellite dishes where they didn't really have much tech, just a lot of rough kids. They're all throwing rocks at the satellite dishes.
Sibs.
That's so funny. I didn't know
You've done that a few times.
So heads up, who's stolen the car?
We can't admit that on this show. So going to Miller, I was
This is
looking
not financial advice.
we'll have to put a lot of disclaimers before we get to that. But going to Miller and looking at the house I was living in, I was there for about 4.5 years. Best friend bought it. I actually Googled it before the show. In 2010, he paid $285K for it, 600 square meter block, 4-bedroom house. And then I looked at today's value. It's actually for sale today. I was like, oh wow, it's for sale, and the auction guide is at 1.1 million. So I go, okay, so 2010, 2016, not a bad return if we look at that.
Absolutely.
But that street was a strange one where that street seemed quite clean. But I used to watch the junkies walk past my house every day, and then around the corner, it's like a no-go zone. You'd walk around and you'd fear for your life. There was just like blocks of what you see in the movies of just housing commission, like full unit blocks, just probably about 600 meters down the road. So
the lesson behind this is that the data might tell you one story, but being on the ground, being one or two streets in a certain direction can fundamentally change the value of the asset.
Oh yeah, for sure. And then probably my other keynote to that is, if there is housing commission nearby, don't just automatically say no, because there is an opportunity there also to buy something which is. So to put in perspective, there's the housing commission here. There's that property where we were at, and then next suburb down the road was actually a little bit more affluent and a little bit more affluent. So there's a bit of a ripple effect. So I might let Matt elaborate, because he just released an article the other day about these no-go zones and everything else.
We did a correlation analysis, because I get asked this question a lot. And we did a correlation analysis between long-term growth and the percentage of housing in a particular area. And it starts getting, by the way, housing today is different from before. So in a sense that it's not centralized as much, it's more dispersed. It's not as an eyesore as it was before. Now, in saying that, I think when you get to about 10% within a particular suburb, it starts hitting that friction point where the growth or the doubling effect can't really happen, or happens at a reduced rate. But and that's a lot, by the way. 10% is a lot, considering Australia-wide. Now, when you go to 1, 2, 3, 5, 6%, which is, essentially the areas. I want to know, I have to check Miller, what percentage it will be. Bottom line is, there is no direct link between lack of growth and the percentage of housing in an area. So what I mean,
direct link.
No. Unless you're at the very high spectrum. Now, what is interesting and what Hung pointed out, I was about to call you Jung because I do psychology. What Hung pointed out is that, you have to look at investing as a strategic decision. So there's a lot of, myths in the investment space, for example, don't buy it in housing area, but you buy it at a discount. Don't buy next to train tracks, but you buy it at a discount. And then the mechanics of growth need to be understood, because usually, think about it this way. You have an area where the premium pockets grow 15.6%, but the not so premium pockets, obviously you're not going to buy the housing commission house, but next door, not so premium pockets grow at 13.8. You're still way ahead of the Australian average, and you bought it at a discount. So when you look at the actual compounding growth rate, you actually turns out better. So what I'm trying to say, and I see a lot of investors ask me this, they analyze an area from 50 data points and they say, oh, well, there's some public housing in the area. It doesn't matter. It does not matter. You can buy it at a discount. Well, obviously, stay away from the outliers. Don't buy in that, scared for your life section of the area. But if it's next door, a couple of streets away, it really doesn't affect growth rates, unless it gets to that very, very high level of 10% plus in an overall area.
And Michael, you've been nodding a lot with some of these insights.
So the short answer for everyone is no. It doesn't affect. If I could go back in time, I would just buy Mount Druitt at 200K as the entire strategy. Just 10 Mount Druitts.
Yeah, look at that.
For $320 a week.
Yeah.
On a 200K purchase, performed way better than my Bondo unit. Well, pretty much the same, but the Bondo unit I had to pay for, I had to work for, I had to take money out of my weekly wages to pay that negative. I was young, I wanted to flex, and that was very, very wrong. But yeah, Mount Druitt's absolute gold. Same as Logan. So many millionaires come out of those areas. It's not funny. And I think A lot of people are focused on the wrong metrics. I want a property that's not in a high crime area. I want a property that has, limited or no public housing. Mate, these things are irrelevant when it comes to price growth.
Yeah, it's like it's as Hung has pointed out, like there are certain caveats that you have to consider. I mean, as I said, compounding good decision making. Don't discount the suburb just because you've got public housing, but if you want to compound good decision making, find a better pocket. You know what I mean? And then search and use it as a leverage to buy it at a discount. You're right away, you're making money at the purchase. So that's the key thing. If you can, and which is in alignment with Michael's strategy. Like if you can buy it at a discount of 20, 30, 50 grand, you already made money essentially.
Yeah. I'll probably add a note to all of that as well, just to, from my observations over the years, is that when people are buying at a discount, and they might be buying a property which might not be as attractive to the owner occupier at that stage. But what happens is the yield curve increases massively because you're already buying at a discount, right? The rents don't shift like that much difference between the better house and the house that's maybe a bit closer to the housing commission, train tracks, whatever it is. But the price difference is huge, right? But your yield curve increases massively, so your holding costs reduce massively, right? So rather than having to take money out of your pocket, so you can go to a barbecue and obviously show off your Bondi unit.
Hey, it's got to be done.
You've actually, you're investing smart because you're not now having to fork money out, which gives you the ability to now go buy another property. Because imagine you bought 3 of these Bondi units, all of a sudden it's costing you $1,000 a week to hold them. How are you going to get to your 4th property? How are you going to get to your 5th property? It's impossible.
And that's the big thing there with doing, buying the 320K rent back in the day for 200,000. They're now worth what? What's Mount Druitt now? 1.1?
Well, yeah, they probably average at least 1, depending on the house.
So looking at that, if you're looking to scale a portfolio right now, yields are super critical, especially earlier you touched on, what's going on in the economy and the property market. We just had the rate rise yesterday, 0.25. There's more coming. You need to be super careful with what you're doing. You need to really be buying entry-level real estate. And the entry-level real estate, when you buy entry-level below the typical and then you buy it under market value, you have solid yields. That goes a long way, especially if you're an investor looking to, have 4, 5, 6, 7 properties. It's critical.
Now, I want to dig a little bit deeper into the housing commission point because it's not something that I'd considered before, and I think a lot of our listeners it would actually come as a bit of a surprise. And I want to look at those data points that balance it out. So the big example that I think of when we're talking about this is ADS. So for our interstate listeners, ADS outside of Campbelltown in southwest Sydney, outside of Seatown.
I didn't even know that.
We can still buy, places there in the 800s.
Yeah.
Why is it that if, social housing is less of a factor than we think, that there are still places that seem quite, even compared to 1, 2, 3 suburbs away, seem quite undervalued? Is it the yields? What other data points mean that this suburb is undervalued relative to other suburbs? Now, it might seem like a very easy question, but internally, I would have just boiled that down to social housing.
So the question is, what's the question? The question is, why is the suburb sitting at 800K while surrounding suburbs
could be in the millions?
Yeah. Well, again, supply demand. I'll give you an example. Like, you could have a suburb that's sitting at 800K with the medium income is $750. And you don't have a threshold of buyers which will push the price up. Or you might have an oversupply in that area. You might have, when I say oversupply, I mean more listed houses than demand can absorb. So, growth 101 in economics is reducing supply, increasing demand leads to growth. That's 101, and those are the primary things that you have to consider. But, it's not, we have to be careful to assume a correlation to a single metric. There are many other reasons as to why. It could be, as I said, the socioeconomics is lower, while there's also public housing. Now, when I say socioeconomics, I mean the affluence, the purchasing power of the area. There's maybe too many properties on the market. The unaffordability is high because the lack of the socioeconomics. Again, we're combining this into a story to realize as to why. And this is why it's dangerous to isolate, to assume, for example, the appeal of a single area from a single data point. It's very dangerous. So you got to connect it and see, okay, what is the story? Why is this? And in some instances, by the way, you might find value, as you said, maybe it is unreasonable from your analysis for that to be sitting at 800K and you see value and opportunity. Now, counter-cyclical investing or investing where essentially nobody else is looking, this is, the magic pill. You just have to be certain in your analysis. So I live close to that area, by the way. I live in Denham Court. So some of those areas, yeah, you're right. They've grown in value a lot. And if there's an opportunity, Campbelltown or whatever, I'm not sure, I have to do the analysis, and everything stacks up and it's at 800K, maybe the market is mispricing it and you have to go for it. So 2 insights. If it's sitting at 800K, could be providing value. So you have to analyze as to see whether there's value there, and you have to look at supply, demand, affordability, socioeconomic, all of these other factors. And then if there's no value, it might be because, I'll give you an example. Suburbs that have a socioeconomic score of 1 and 2, which is, it's an HtAG score from 1 to 10. It's an index of socioeconomic advantage and disadvantage. If you have a score of 1 and 2, suburbs that hit 750K in price point hit a friction ceiling. Yeah. And they can grow past that point, but not as much. There's 16 suburbs in Australia that are at $1 million mark with an HtAG score of 1 and 2, all 16 are located in New South Wales and other suburbs that we just talked about. None of them outside of New South Wales. So maybe it's hit a friction point. Maybe it can't grow more because of all of the other factors.
Yeah, and you're not going to attract that owner-occupier market that's paying that bit of premium. That is probably, working class, that they have the serviceability. They're going to go to the surrounding suburbs, and literally a street can change the game totally. So they're willing to pay to wake up and not have their car on bricks in the morning.
It's funny because you could have, it's usually one main road separating it. So I'll give you an example. It's the Cumberland Highway. It's in the western suburbs. You've got Greystanes, and across the road is Marylands, right? And the price difference, I kid you not, is between 30 and 50% difference between that. It's like a 6-lane road, right? So to cross the road, it's too much effort.
I never looked into which one's higher. Which one's higher?
Greystane's substantially higher. Yeah, substantially higher.
But see, there's that's interesting. Yeah, exactly. Yeah, that's.
But it's couple of close, splitting it, right? So you can't get across the road, like. But Marylands has a train station. Greystanes doesn't. So it's it's bizarre, right, in a sense. But when
I'm going to look at that. I want to see why.
When you actually so we'll go back to, I guess, then that raw, take the data sets away. Let's when I look at maybe buying an owner-occupier, I'd probably spend a few days kind of surfing around the area, just kind of sniffing around and see what it's
different space.
Yeah, and then you start to really feel the difference. Go to the local gym, go to local shops, and then really just start. If that's an owner-occupier, if you're doing an investment, pure strategy is different, right? But at the same time, that's where you rely on your instinct or your buyer's agent to figure it out.
Yeah, I had for that disparity between data and behavior. I had a question in Mastermind the other day, how do we pinpoint, because when we go on the ground, it might be different from data. And I think the issue there is that people are not connecting too many dots. And I'll give you one example. If you have very high socioeconomics, a low renter to owner ratio, I can guarantee you, low renter to owner ratio and high socioeconomic score of 9 or 10, I can guarantee you that when I go there, the lawns are kept nice. In the front yard. I can guarantee you, I have so many examples. I remember Taylor Hills in Victoria. I didn't go, it was one of my favorite suburbs 2 years ago to invest into, around the 800K mark. And I knew the appeal of the suburb when I looked at and connected certain data points. Then I went there and you can see people actually competing who's got better lawn. You can actually see the danger becomes when you have a very low socioeconomic standing, high renter to owner ratio, it's not populated by owner occupiers, hold periods are lower, they're not 10 years, they're like 6 years, or 5, which means that people sell houses every 6 years. That right away tells me, okay, there's something for concern. And I go there and you're right. Then I go to the local gym and I get shanked. What I mean? That's things like that,
unregistered car metric, right? So when you drive, you see all the unregistered cars and the number plates. That's what you should invent that.
If you go to the local gym and you see 100-kilo dumbbells, you're like, oh, all right, I'm going to get the hell out of here.
There's tatted up guys everywhere looking at me.
I'll tell you a funniest stat. It was actually, this is not really a stat, but it's a friend of mine opened up a gym in Marylands and he was competing gyms, right? This is a funny thing. He goes, we are not putting dumbbells bigger than 30 kilos because we're trying to avoid the steroid munchers because the Gold's gym down the road, they've got 50, 60 kilo dumbbells. They can all go there. We actually and I never thought that they thought about this metrics when opening up a gym because they were looking to capture that Greystanes market. And the affluent Marylands
maybe you should put yoga in there as well.
Yoga, Pilates.
They got
the firebombed. It'll be gone in a day. Now, looking at this, we're touching on there needs to be that element of PPOR, owner-occupier demand, to maintain that floor and the desirability in an area. But I'd love to get some insights, and I know Michael mentioned it before about interest rate rises. We're going into a little bit of an uncertain economic period.
Yeah.
I think it's very fair to say, by the time this is recorded, we found out in the last couple of days that we did raise the interest rates by 25 basis points. My opinion was it was going to happen anyway, with or without what was going on overseas. Yes, it's flowed through a little bit in the last couple of weeks. Ultimately, the inflationary pressures, they're still to come from overseas. I think that we'll probably on the hook for 2 or 3 rate rises regardless of that. So there's more to come. Even if the war wraps up in a couple of weeks and we all go back to where we were before, I still think there's more on the horizon. Gentlemen, to the three of you, and I know you each have your own special areas of expertise, probably starting off with Hung, what are your thoughts on potential rate rises? How can investors get ahead of the curve? And what's it going to mean for property investing over the next year?
Yeah, so as the boys mentioned earlier, the affordable markets still seem to be attractive, right? Because everyone is gunning for that at this present point in time. If you are a mortgage holder and you're a little bit stressed or tapped out around your cash flow, you probably need to talk to your broker to talk about maybe rebuilding or drawing equity to build up that cash flow. People starting to talk fixed rates. That's, you don't fix to beat the bank, you fix because you need peace of mind. So there are options to split and go part variable, part fixed. There's people are doing a lot of that at the moment because they do need that peace of mind. It's not necessarily about beating the bank, it's about sleeping at night. So they want to go to sleep at night.
Predictability, essentially.
Yeah, exactly.
So if someone's worried about that and they need to talk to their broker, anyone good?
No, there's a couple of guys out there.
Fantastic.
Yeah, no, they so there's that factor, and I guess the future of it, if there are still more rate rises, remember when they do go up, eventually their target rate is much lower than where they are at the moment. So you've got to keep that in consideration, but I guess plan for the worst, and then in the best case, when they do go down, you'll be in a very good position. And if you are buying, the best time to buy is when rates are rising, right? So
best time.
I tend to agree. It's a case of what, at the end of the day, and not to be dismissive, because there are a lot of people that are doing it really hard, but there's a cost of doing business in property, and maybe it does sound a bit callous, but at the end of the day, if $100 or $180 at the end of the month is going to stop you investing, you're in the wrong game.
Investing, yeah.
Exactly. I mean, if you're, again, not to be callous, but if $180 at the end of the month is going to change whether you're investing or not, what happens when the aircon breaks, or you need to get an electrician in to do repairs, or there's mold in the walls? Well, you're in too economically precarious of a position to be investing here anyway. And of course, I think investors, again, not to cast a broad net, but people are too used to a quick sugar rush. It's like,
Absolutely.
over the last 5 years of
Perth is to blame.
Brisbane, getting 20% annual returns. You're getting used to this sugar rush. Like, well, you have to go back to what it was 20 years ago, where you had a 30-year strategy. Sometimes you're gonna have to do a buy hold. Sometimes you have to sell.
Yeah.
Look for the long term. Don't look for the short hits. Now, I don't know if you disagree with any of that, but yeah, feel free to.
100%. You need to be buying. You need to be buying during this time because the less buyers, the better. In terms of competition, all the emotional buyers will be out now, and it will just be the ones who are following their strategy and working towards their end goals. Right. Some of the best deals I bought, even for myself, were during that period of time where we had those 13 interest rate rises. Picked up off market, under market value houses that were a mess. Did the quick tidy up, and they've doubled in value in these 3 years. So buying at that right time, there was no, and that was off that particular deal I'm talking about. It was on realestate.com. No one wanted it, so it was online. It wasn't off market. They're out there, and this is the right time, because later on, and it's inevitable, because we've watched this play out before. Things will start to get cut at some point. Investors will come back, serviceability comes back, or so on and so on, and you're going to be on the back foot.
What are you seeing anecdotally from buyers at the moment? Is there concern, or we're at the same interest rate that we were last year. It's not like the world's burning down like what you read about in the news. We're at the same interest rate that we were 12 months ago, so it's kind of the same. Right?
I've heard from a few brokers that the investors have dropped off.
Yeah.
For us, we haven't really noticed it as a business, but they are dropping off, definitely. The ones who know the game and the ones who are working towards, 4, 5, 6 properties and so on, they're a little bit more educated and have that risk appetite. They're in the space, and they're continuing with with acquisitions.
No, agreed. No, I do think that there's more growth on the horizon, and not just saying this to, as confirmation bias. We were talking about psychology before. I don't think it's necessarily confirmation bias. We've spoken about on previous episodes in the building and construction industry. It's a very capital intensive game, and if you're building a lot of houses, if you're building a lot of units, chances are you're not self-funding, and you do have some debt coming in. We already see that the levels of insolvencies for our builders right across Australia are at historical highs. Yes, a few more interest rate rises, that supply of new builds will taper off. And just this morning, the migration stats came out that you're looking at another 600,000 people over the next 12 months at its current figures. So we're still at that record levels of high migration. And once the building approvals start tapering off, or the construction outcomes start tapering off, it comes down to the supply and demand that we were talking about before, Matt.
I agree with all of the points made. And I think the crucial point when it comes to investing that I don't see a lot of people address, including buyer's agents and every professional in the industry, is that a lot of them, not all of them, but a lot of them, what is the exit strategy? When you buy a property, have in mind what are you buying it for, and where's it going to take you, where's it going to lead you, when are you going to exit, etc. Like, for example, coming back to the sugar hits. What happens after the sugar hit is done? Because nothing grows perpetually in value. What happens when it subsides, goes down, goes negative? Can you hold a liability instead of an asset? So by you inadvertently planning ahead or having an exit strategy, if I'm going to use equities as an example, by having an exit strategy, inadvertently considering, the mortgage, the increases, the rate increases, everything else, your cash flow, your portfolio. Did you construct your portfolio to see how this purchase fits into your overall story, all of these other things? So I see day in and day out investors, let's say on strategy sessions, they send me the portfolio that they have and they want to buy the next property. And I look at the properties that they bought at the wrong time, in the wrong area. Yes, they got 15 or 20% return in the last year, but that's it. It's going to go down. It's about to nosedive. That inadvertently tells me they have no exit strategy. They don't know why they bought in that area. So essentially, if macroeconomic conditions are changing, plan for it. And by the way, banks are taking into consideration. They're going to give you a loan if you can actually support it, and they have risk mitigation strategies. So again, to your point, if $150 is going to hurt you, don't rush into it. Don't be persuaded by FOMO. Don't be an emotional buyer, which comes back to rational decisions, planning, data, and everything else. So, it's when there's blood on the streets, buy property. There's that saying, So, in a sense, nothing. There's no these doomsday scenarios that don't really align with that. There are going to be substantial structural changes the next decade, absolutely. Which you need to take account of. But how many times I know from my experience, I didn't buy something, I didn't invest in equities, or I didn't buy a property, and then I would see 10 years later, it's grown 150%. So again, the confirmation bias, have some form of meta-reflexivity when you're sort of analyzing yourself and asking yourself, why am I buying? What is this intent? Is it a sugar hit or is it a long-term plan? And if you do that, you'll be safe,
Do you think that there are markets there where, and looking at what you were giving the example of before, where people have bought into those markets that have kind of already seen their growth, that herding behavior, they probably heard about it from their uncle at a barbecue that made a bunch of money buying in this suburb 5 years ago. Now they bought in right at the end. Do you think some of those suburbs, and we don't have to name them, we don't even have to name the cities, but do we think some of those cities or suburbs where there was such a herd of investors in, do we think that they might start paring back?
There's two things there. First, there's herd, absolutely. Second is malpractice is a strong term, but I think it is the inadequacy of professionals that were servicing them because they didn't buy for the individual brief. And I'll give you an example. If you have a long-term investment time horizon and you want something to double in value, the best thing to do would be to buy at the upswing of the cycle, not at the top, because then you have to expect stagnation for at least 4 or 5 years until it kicks again. So did the professional explain to the individual, we're going to buy here, you're going to get 25% in the first year, but it's going to start tapering off. By the way, that can be one of the strategies, and a lot of people do that when they want to build their portfolio fast. They want to get that initial sugar hit, they get the 20%, it starts subsiding, but the area needs to go through another round of growth. So they need to analyze that as well. So bottom line is, it is not buying under the individual brief, not even asking that question. What is your brief? Why are you doing it for? So that's the first question. The second one is the problem of social media. you know, because currently how people differentiate themselves is they fight online 15 rounds about who's got a better suburb. And as soon as that happens, I can see that they don't know what they're talking about, because a suburb for me, that's great, that's great investment, is not a great investment opportunity for you. So it becomes superfluous to actually argue about suburbs, because we have to tie it back to the individual. So, and then people usually, you know, when they hear stuff online about certain things, Perth.
Yeah, but
You
this
know,
is
let's
what
go to
people do in
Perth.
forums and stuff need to stop asking, hey, what's a good suburb?
Yeah, that's
Hey,
the,
would you buy here? That's the
What's
worst.
I get this. I get that asked like 1,000 times, and the answer is always, for who, under what brief?
Yeah.
And they're like, oh, Matt, why are you being difficult? No, I'm not being difficult. I'm telling you how it should be done. You know, Gladstone is a great investment opportunity if you're going to hold it for 3 years and exit. But if you're going to hold it long term, no way. You know what I mean? Because of the fluctuations and volatility and the sensitivity to macroeconomic changes. So again, I think to answer your question, sorry, I got excited a bit there. To answer your question, two things. First, it's a herd mentality and persuasion that happens online. And second, it's the individual not understanding what their brief is and why they're investing, and the professional not advising them about their brief. So those are the two culprits, I would say.
But everyone wants an opinion from somebody that's not qualified to give it as well.
Yeah,
so, for example, it's like, what do you think of this area? Like, or it might not be me. They might be asking it to the uncle at the barbecue or to, and they place a certain level of trust in the individual because they know them. So, for example, if it's my uncle or it's my dad or if it's a family member who might be a real estate sales agent in Bosley Park, we'll throw Bosley Park out there.
Shout out to Bosley Park.
Shout out to Bosley Park. But you know, you're asking because you know, like, and trust them.
I also went to high school there as well.
Did
by the
you?
way, yeah.
How many high schools did you go
All
to?
the dodgy areas.
I'll explain this. I'll explain.
So we're placing we're putting a lot of weighting on
swear I
that
did.
person's opinion when they're not the best person to be taking that advice from.
100%. I mean, because that's where you're going to get that confirmation bias. Like, I hate, and I think it's very fair to say, I hate recommending buyer's agents to people, because it's one of those things that everyone's been there with the uncle at the barbecue, getting the shit advice. And, you know, back earlier in your kids, everyone's probably done it as well, giving the bad advice. And you don't want to be held liable for something that's outside of your comfort zone.
Or it'll become Liam's fault when
It'll become
when
Liam's
that
fault when it
bicycle
goes,
doesn't
yeah, 100%. Or, you know, all it takes is, you know, there's a little bit longer of a wait list because they take, and then they get very angry and sour. But that's the life of property advice, right? I want to take a little bit of a pivot change, because looking at the realm of yield, it's quite important. It ties into what we were talking about before with Matt about it tapers into what stage of investing you are. Can you afford to hold something with a lower yield for longer term growth? But I'll throw it out to Michael and Hung, the role of rent as a catalyst in growth markets. What do we make of it? And how does it apply to investing in 2026? Maybe Hung, Michael first.
Yep.
Yeah.
Huge. The way in which let's use some good let's actually use examples. Perth and Brisbane having those strong yields. Remember, you could buy a house in Brizzy for 200K, 350 rent. Perth, when I went over there and bought my first one, 2022, you know, 300K renting for 450. With it, by the next rental increase, it was like 600. Right? That is a huge catalyst for growth. And back in the day, before we had all the data sets we had, rent was huge, because rent allows you to not only be able to scale a portfolio and have serviceability, but also not have that negative impact on your week-to-week cash flow. And I found that markets that have stronger rent tend to jump in terms of capital gain a lot faster.
Yeah, probably what I've seen over the years anyway is a lot of these markets where they've got really high yield but very high intrinsic value, which I always bring back to, where, for instance, the land value might be 500 grand, but you can buy a house for 550K and you're still presenting very high yields, right? I've noticed that these are the best markets that have not just grown on growth, but they've also been easy to hold with very low vacancy rates and high pressure on demand. You'd naturally just see these markets do really, really well. So the best purchases I've ever made were kind of presented that way. So it's always, I always buy high intrinsic values. My kind of buying process, I always just look at, if the house burnt down, what's the land worth? If I was to rebuild the house, how much would that cost me? And so maybe I'll give an example to put a lot of the stuff we put together into one. My last purchase, it was a WA purchase. I didn't want to buy in WA again, but opportunity presented. The land itself was probably presenting close to 600,000 for the land. The house was a 4-bedroom brick house built in 2013. You go replacement cost probably 600 grand, paid 740 for that property, right? And the yield was probably about 4.6, 4.7. Not as high as I wanted it naturally to be.
Gross, you're saying gross yield.
Gross
yeah?
yield, gross yield. Not naturally as high as I wanted, but the intrinsic value was there already. Settled the deal maybe 2 months ago, and then got it revalued almost 120 grand up on original value, right? But I already knew that because we bought below market, so that's already, if I'm losing, and the interest rate on that one's really high, so I know I'm going to lose about 3.5% net on that property based on cash flow for the year, but I'm already way ahead of it because I know that the capital growth or forecasted in that particular pocket is probably going to hit the double digits, which are going to outperform. But yeah, going back to, I guess, the yield play itself, looking at other markets that are performing at the moment, we're going to bring out the big Darwin word.
Go.
Let's have a look at Darwin.
Huge
Probably
yields.
the best performer in the last 12 months across the market. I think it's pretty close to Perth, but they're depending on units or townhouses or houses or whatever you're looking at, or total market. But that market's grown massively. In particular pockets, when you look at it, the yields were at 7.4 to 8%.
Wild.
And the intrinsic value on these properties, you purely land value and house combined, you're buying stuff at six to 700,000, where the intrinsic value in my eyes were presenting close to $1 million, because it's very hard to construct in Darwin. People don't realize how expensive it is to build a house there. And there's a lot of infrastructure projects going on there. So there's a lot. Look, I don't really like the rent to own occupier ratio, but the demand for housing is very, very high there. Maybe I'll let Matt explain a little bit about what's happening in those markets.
No, I mean, I agree with everything. I think, again, let's first envision what happens when the yield is high. And I always use this example. I say, imagine there's 10 people in the area, 8 of them are going towards renting. It creates pressures on, and vendors have the opportunity to actually increase rents. Now, when rents increase to a point where ownership becomes more sensible, you see a transfer of demand from rental to ownership. Now, there are 2 types of yield markets. There's a yield market that will never grow in value and a yield market that will. So that's why purely focusing on the yield aspect could be dangerous. And I'll give you an example. Newman in WA has 7% yield, but has seen minus 35% growth in a decade. Why? Centralized industry, fly in and fly out towns, all of these other things. So if you're going for the growth play and using yield as a proxy of assuming that the growth will happen, dig deeper to understand the actual market. You have a lot of other markets that will grow in value where yield is high. Perth, Townsville, Darwin. So Perth was, in 2020 or 2022, a high yield market. So was Townsville, so was Darwin a year and a half ago. So now yield becomes, also the yield equation is very important. We need to understand that it's a seesaw, because you have the price of property, the rental demand within the same equation. And coming back to the 10 people, you never see yields increase at the same pace as capital growth. It's either one or the other, So yield is crucial for a brief that it wants to invest in a market at the bottom end of the cycle when it's about to uptick. Because usually what you see when markets increase in value and reach the peak, you experience the yield compression, okay? So the yields are important because they invite investors, and you need 2 cohorts competing for the same asset. You need both owner occupiers and investors competing for the same asset to increase the price, at which point you experience yield compression, So coming back to, there's 2 types of yield markets which you have to be wary of and understand. You need to have high yield plus all of the growth drivers, high levels of affordability, higher socioeconomics, no supply, improving demand. You need to have that for the yield to play its role by inviting investors to the market and owner occupiers competing with them. So absolutely, we have it as, one of the highest significance metrics, not the highest, one of the highest significance metrics for an equity extraction timeframe of 4 years, meaning you're investing at the bottom of the cycle. In 4 years, it's going to get to a minimum 20%. Minimum, under promise, over deliver, So, absolutely, it's important. Now, it doesn't really play a role when you think about it when there's yield compression happening. I mean, it does for an individual in the sense that I still need to pay the loan off, I still need to maintain the property, but at that point, it's not the yield that's driving the growth. It is, and by the way, higher renter to owner ratio, there's positive and negatives in everything. What people don't realize is, for example, if you have a very high yield market where ownership becomes very enticing, you could see a major shift. Let's say Darwin markets have a 50% rent to owner ratio, 45, yeah? In some markets, Djolic, let's use that as an example, yeah? In markets where yields are too high or high enough and property becomes affordable in comparison to what you pay rent for, there's a huge pool of buyers that could shift from renting towards ownership, you know? So again, see the dual aspect of each metric and how you can relate it to behavior. So bottom line, yeah, I agree. Yields are very important, especially at that initial phase of the market because they entice investors to come into the market. While owner-occupiers kickstart the growth anyway because of the first purchasing in any instance.
But there's an inflection point there I mean in terms of location, there's an inflection point where when it does become a hyper remote community, I guess the best way to put it, where you do have that single industry, the risk of volatility comes higher, such that the yield play at its heart is less impactful as an investment strategy, or more dangerous.
Less impactful in terms of portfolio building?
Danger, in terms of the volatility.
Yeah, so again, when I see a high yield market, the first thing that I look at is actually the price curve. If I see it behaving like a snake, I dig in deeper.
It's probably a snake.
Yeah.
This is area terminology as well, isn't it?
Where there's smoke, there's fire. No, but if it's behaving irregularly, let's say, in comparison, and everything is a comparison. Everything is superimposition, you know. You see very stable markets, the price curve is going up like that. So if it's behaving irregularly, then I dig in deeper. Why is it behaving irregularly? Then I have a look at industry centralization, exposure to negative environmental effects, dominance of mining in agriculture, and usually when I tick those 3 boxes, I already know why.
Yeah.
You know? So
it's just a boom and bust town.
Yeah, like it's Newman, as I said, a great example. There's a lot of towns like that where you have, and what's interesting about Newman, now, is Newman a bad investment location? No, but for a particular brief. Newman has seen 80 or 90% growth in 5 or 7 years. That's a lot. And then he nosedived. Why? Macroeconomic changes, the mining project finished, they went home, wherever their home is, et cetera, et cetera. So if you're trying to time the market, which is a very dangerous strategy, I would advise against, you can maybe find value in those markets. But if it's a long-term investment strategy, you have high yields and then there's no industry diversification, et cetera, I would call caution.
No, that's very wise. Now, looking at this in terms of getting those long-term purchase strategies, how do we, and I'm going to throw this out to everyone, how do we identify areas which have the potential upside through gentrification? I feel like this might be a bit of a finger in the wind type thing. Are there any data points that we can identify that point to gentrification over the long term?
That's one question that I get asked a lot, and usually I get it asked in a very interesting way. So I get it asked, people mention gentrification when I show that the area is a bad investment location for them, and then they say, but what if it gentrifies? That's like the last point of call, you know?
What if? You're kind of like clutching at straws there to justify it.
Yeah. So it's like this abstract. Now, the thing is about gentrification, and I think the great proxy to analyze that would be, again, the index of socioeconomic advantage and disadvantage. And ABS publishes results. You can literally download those results off ABS websites, and you can see how much, and we publish those results in Mastermind, how much socioeconomic underpinning of the area really changes. Changes marginally. And it takes a long time for it to happen, which brings me back to the brief and time frame. For example, if, first and foremost, it changes at the either side of the spectrum, the bottom end, i.e., socioeconomically disadvantaged, and the higher end, very advantageous. And when it does change, it changes marginally. You never see a jump from 1 to 5 out of 10. You see a jump from 1 to 2, which is still disadvantageous, and it takes over a decade. So if the timing is the factor, how can I quantify the positive return I will make from this gentrification at what point? So this is very important to consider. If you're building a portfolio, you can't make a decision on a what if it does, and even if the what if will happen, what will be the quality of the return and how can I quantify it? How will it impact my portfolio? At which stage will I see the return? It will be 15 years later, and if it's 15 years later, what is the opportunity cost? Would it be better for me to put it somewhere else as opposed to banking on gentrification? So overall, gentrification does happen. Redfern, you know, but again, pockets. Redfern, again, has pockets where you wouldn't go into, but it has great pockets because of restaurants, etc. And how long did it take? Think about it, guys. It took 15 years.
15.
You know, it took a long time for that to happen. So it does happen. It takes a long time. The changes are marginal.
And then you fall into the risk of trying to time the market again.
Correct. And try to time the market in a long-term game, which is even more silly. I mean, you want a sugar hit on the one hand, and then you're timing the market, and then
timing the market is a short-term game.
Yeah.
It's not a long-term game.
Yeah.
But the what if metric, definitely can't use it. Also, I plan on buying here because I might retire here.
Yeah.
Strategy. That's another one that's absolutely shocking, which definitely shouldn't be done. But
So take us through. You would have happened to identify some of those markets which did gentrify. Not really a what if. I'm sure you would have seen it, Michael. How did you go about selecting those markets for your clients?
Yeah.
What was your process of doing it? And how did you take them on that journey?
I bought plenty of markets that haven't gentrified as well, 100%. So I've missed out on some that I couldn't pick, like Palm Beach. I couldn't pick that.
Is that's
Gold Coast.
Yeah.
That's become a new trendy place. And anyone that's been to Palm Beach in the 90s would be absolutely shocked.
What was it
at
like
how
in the
it's turned out.
90s?
I don't know. It's just, I don't know. Jeez, if everyone's watching, I just thought it was just a housing area. It was the Gold Coast housing area, in my opinion.
Yeah.
People will probably say there's a couple of others, but to me, that was the vibe that I got as a kid. And anytime we were there in Palm Beach, because I lived on the Gold Coast for a little bit, and it had that vibe. But yeah, totally missed that. And then Byron Bay as well. Like,
how long was that ago? How long was
the
it?
90s? It was the 90s. But
Again,
I really
time
think
frame.
Palm Beach. I really think Palm Beach really took off post COVID. It was that. Gold Coast has just taken off post COVID. But going back to it, I mean, I'm really focused on the stuff. The point that Hung made earlier about below intrinsic value. So looking at markets that haven't moved for a while. Not so much looking either for the gentrification. The gentrification doesn't really play a huge part in what we do. If it happens, it's a bonus. It's a longer term bonus, but it's not something that really comes into the strategy. So it's looking for stock that's literally below market value if you can buy it. Looking for stock that's in a market that hasn't moved for some time. Kind of like going to Perth for the $300,000 house. In 2019, buying a $250,000 property in Kingston, in Brisbane, that's on 800 square metre block of land. That's now with 800,000. Looking for things that are value for money that can't be replaced at the same amount, and then making sure supply and demand aligns, and you've got that yield to make sure you're not dipping into your pocket, and that's the strategy.
Yeah, see, he can quantify that. That's the important bit. That's the takeaway. He can quantify those characteristics. You can't quantify the ramifications of gentrification. So if it's going to be a decision-making factor, where does it sit in the hierarchy of decisions?
So
you have to ask yourself.
With crime rate, somewhere down the bottom. Somewhere down the bottom.
You got to quantify things. You have to feel them in order to make a decision. If it's like a what if, it's the allure of finding the holy grail that nobody sees.
Yeah, that's that extra layer on top of all the data.
So does it exist? Does the Holy Grail exist?
It exists, but it's not what you should.
It does, but it's very simple. When we see it, we'll go, oh, is that it? That's the problem.
Yeah, I'll probably throw an example there. If you look at, say, Granville, Auburn, right, in Sydney, that is the centre of Sydney. I don't know if anyone realises that.
We're buying Auburn right now.
This is where I will say, look, let's talk about gentrification, right? Those pockets for the vicinity to the city and every other surrounding suburb around it, very good value, right? When you look at where it's at.
Man, you know what it is? Like, I'll give you an example. It's the Newtown effect. Like the new, and it's you got all these like trendy, well-off kids, and not being like dismissive, but you have a lot of these trendy, well-off people that try and go to very artsy areas like Newtown in the inner west, and you can see it year on year, and they're shifting further west and they're shifting further southwest.
Yeah.
That's affordability.
That's affordability.
Yeah, it's affordability, right?
Affordability.
And so now it's areas where, Burwood was always a bit of a, an economic hub because you had like the Westfield there, like a lot of businesses there, very big shopping district. But now you've got areas around there that are now becoming trendy themselves. And I don't know, is there some kind of quantification here where you can count the amount of like septum piercings and the amount of people with blue hair, where...
Absolutely. That's an interesting metric.
Maybe add it in. But in terms of that demand, because that's where you get the social utility of it, right? Because there is, and this is not quantifiable, but that ties into the gentrification argument, right? Which is, utility has its role to play. The gut feeling that we were talking about before, and that's why you were seeing yields blow out in areas like, well, not necessarily if you were to buy now an apartment in Ashfield, but if you bought an apartment in Ashfield 10, 15 years ago, you'd be cheering.
Yeah.
You know, from the purchase price, you'd be doing quite well. Now, what term? This is going to be a little bit. Maybe people are going to give up their secret sauce a little bit, but I'll put it out there anyway. You don't have to give the exact postcodes, but what are some of the best long-term markets you are seeing today, and why? And I'll give this across to Matt and Michael, and then over to Hung for his broker opinion.
There's grey markets everywhere. You know, I mean, what are we seeing on the state level? Every state is growing in value. There's a deceleration in some states. Queensland, you know, in some pockets, WA, Melbourne is accelerating, Tasmania is accelerating. So I wouldn't bring it back to markets. I can say a couple of areas, it's fine, but what I look for is, again, affordability, great socioeconomics, long-term stability, lack of supply. It's as simple as that. And some markets that really match that criteria. I mean, I've loved, as I said, Taylor Hills 2 years ago, and it's delivered phenomenally. I loved, and sort of still do, but I think, you know, you're missing the boat if you want to enter early in the cycle. Love Williams Landing in Melbourne. You know, there's Alfreton, those are some of the, you know, Melbourne areas. Queensland, depending on the price point as well, you know, Cairns was potentially a play. Now we see a reduction, increase in the days on market, so it's losing a bit of steam. But again, if it fits your brief, it's...
Has Southeast Queensland done its dash?
You know
or
what?
Is it too broad? Maybe it's too broad.
It doesn't appear in shortly. So Springfield Lakes, is it Lakes?
No, Springfield.
Springfield does, yeah?
Yeah, it does.
So Springfield does.
It appears there. But
again, that's a higher price point.
Oh, I don't want to. I was in Springfield probably a couple of weeks ago. I wouldn't return. But look, it's a
pretty. I've heard it's a pretty.
That's
it's pretty
emotional
rough area,
bias now.
right?
That's emotional bias.
Yeah,
It's a pretty rough
so
area.
that's why it's like it's a rarity that it's a rarity that it's in there. You know, what other markets? Let's say Tasmania has been popping up a lot, depending on the price point. Is it South Launceston or?
Yeah, Launceston. There's plenty. There's a few places in Tassie that are
Lena Valley. We bought there recently.
Lena Valley, Glenorchy.
So they again, you know, all of these suburbs, you know, they're great picks, but for who? Which is my caveat. But again, if you're investing long term, just ensure that you have, you know, the purchasing power of residents, diversified economies. It's not volatile. Ensure that the supply scarcity. As a bare minimum, and any market that fits that. By the way, for example, just learn from history. Why did Perth grow? Why did Townsville grow? Why did what were the ingredients that were there, and try to look for those. And the ingredients were just what I mentioned now. You know, that's
economic fundamentals.
Yeah, it's just economic fundamentals, socioeconomics, no supply, initially higher yields, as you guys have mentioned. That's essentially very affordable. It needs to be very affordable.
And what about you, Michael? Any picks for long-term growth?
Queensland still has plenty of steam.
Yeah.
So not the higher end of the market. We're talking about the Melbourne and Sydney relocators that are going to be buying properties to... Look, I talk to them every day, and I'm on calls every day with someone from Melbourne or Sydney looking to move because they know someone that's moved during, you know, post-COVID in that you know, rush. I think there's plenty of interstate migration happening there. I think it's been leading interstate migration of any state for the last 10 years, and it's continuing. It's due to get the third largest amount of net overseas migration, I think, this year. That combined with, you know, net overseas migration doesn't always migrate money, but the interstate migration from Melbourne and Sydney money is continuing, and I believe we're going to see Brisbane get close. I mean, previously Brisbane... 2010 was the last time that it was the closest in terms of median price to Sydney, and I think that was 49% disparity. I think it's sitting 40 to 45 now. So I think we're going to see that hit, and then we're going to see it go a little bit more. I think this time around is when Brisbane gets the closest to Sydney, and it's because the money's migrating, and people now in the post-COVID Zoom world work from home. And we're obviously seeing Aussies getting older now, boomer generation retiring. I think a few of those Queensland coastal lifestyle plays are still the go.
Yeah.
But keep in the affordable as much as possible. Don't go buy Sovereign Islands, Broadbeach, Watersell.
Noosa?
No.
Yeah.
No, don't buy that.
And you agree, Hall?
Yeah, look, definitely agree. I've probably, for my own pick, it's, big city, big value. I'm going to point at Melbourne, because if we're talking long play, it's probably going to be the city with obviously the most migration. They're kind of saying that the population is going to be bigger than Sydney at some point, whether it's the next 20, 30, whatever it is, they're forecasting that. And obviously construction levels are quite low there. Even when I was in Texas last week, there were people in Texas saying, "Oh, you guys, are you from Melbourne?"
Yeah.
Melbourne.
We saw Melbourne as it was the number one livable city in the world.
They actually spoke about that over there.
Yeah, this is random people in Texas
right.
were talking to me about that. I was like, wow.
I think Melbourne's clutching at straws here. They're just trying to get everyone
mate.
from everywhere because everyone's leaving it.
They go. They saw all of these new bills that they need to pay.
I don't know. Like, I
and
like
then they won the award.
Yeah, I mean,
that award's got to be paid for. Sorry, I just got to say that. Sorry,
man, I am a fan of the old laneway beers, like sitting on a milk crate in a laneway and drinking.
100%.
That is fantastic.
100%. I love Melbourne 10 times more than Sydney.
Yeah, it is the
Sydney
only
is
reason
a-
I'm not there is my wife
comparison.
won't let me move.
I don't love
I back it.
What about Queensland, man? It's
Queensland's the best, mate.
Mate, it's
I'm
for-
still blues,
It's,
but
it's for retirees, exactly. It's for
So
people
why am I
who
working
just,
more now than
bedridden and... No, I'm kidding, guys. Whoever's from Queensland.
It's for retirees.
all
Anyway,
of a sudden Matt's HtAG subscriptions from Queensland go down?
Yeah.
After that comment.
so we're banking on the Melbourne growth.
Oh, look, if you're going long term, I'd bank on Melbourne. Like, this is probably the last opportunity you're going to have to buy at the price levels that you can get into houses in Melbourne. Because in about 2 years' time, the entry level is going to be $1.something million, right?
Absolutely,
To get a standard house there. You can still buy something under 700 grand. That's a house on a 600 square meter block within 23 Ks. That's probably not going to exist
That's that
in 2
intrinsic
months.
value that you
Yeah,
like.
no, I love that. I love that
100%.
intrinsic
But
value.
that's
Yeah.
what we grew up doing,
Yeah.
looking at.
The yields are shit. I'm just going to put it out
Yeah, the
there,
yields are
but
bad,
they
yeah.
will improve because they lost so much population over the last few years, and now they're starting to get a surplus, and they're not building in time. So the pressures are slowly coming. You can see the vacancy curve dropping.
It's just a slow
Yeah,
play.
it's going to be a slow play, but I reckon in a few years you'll see your yields pick up, and then there'll be a
Yeah.
bit of a price war over yields, and then we'll have another inflation problem, and then
But that ties back into what we were
Boom.
talking about before, right? Which is balancing out the sugar rush. You know, the era, whether it happens or not, you guys know the data, you're the data experts, but, putting my thumb on the pulse, the era of the 20% returns being normal, it's kind of done, right? There is an affordability point. What we were talking about before, Matt, in terms of there needs to be that PPOR demand. And, if you've got, one grandparent that's now living to 100, you don't have the inheritance coming through. There is a floor on what people can afford. So
100%, yeah.
you have to go back to the basics. It might be a longer play. There might have to be, you accept that you might have lower yields and it is the cost of doing business, which is lower
I
yields.
love that expression. I always use it.
And
Yeah.
it's the lower entry price point for a major capital city.
Yeah.
Like one of the biggest, right?
I'll probably go back to Matt's point on that one. Is actually it's not a one size fits all, right? Because you might need a high yield
Yeah,
on
yes,
the
of
broking
course.
side in order
Yeah.
to get
Well,
to
it just
the next
affirms
property.
what we discussed.
Yeah,
Exactly.
you might be a 7 property portfolio guy who has yields that are, because obviously they bought maybe 4 properties in Perth and their yields are now at 13% based on their original purchase price.
yeah.
They can afford to put a Melbourne property in there.
Yeah.
So it's not for everyone. It's not a one size fits all box. It depends on your brief, as you said.
Yeah,
And
absolutely. But I
everyone
mean, when you look at just superimpose the price curve of Perth and some of those areas in Melbourne, going back 2 decades, 3 decades, you see Melbourne steadily going up all the time. Hence why the yields are lower. It's as simple as that. The other area is the snake that I was referring to. If the price goes down, yields increase, the seesaw, yeah? So that's why they're higher. Now, again, a bit of an insight. If the yields are higher, inadvertently try to dig for volatility. Why is it there, So Melbourne, I agree, who would have thought that in 2022, when I mentioned Melbourne in 2022, I caused a witch hunt on social media, Literally.
What
2024.
was the
24.
what was the witch hunt?
Oh,
Some
how can you
people firing, crossing each other.
something outside of Perth?
Yeah.
How dare you?
Well, that's the herding.
How
right?
dare you mention something outside of Perth because people get emotionally attached to the gains that they're making.
Yeah.
And they think it's going to last forever, and everything grows in cycles. You know, Melbourne was a great play. 24, you're right. April 2024, I remember.
We couldn't sell Brisbane in the 2010s. You buy in Brisbane, no one makes money there. I've had financial planners tell me that. No one makes money there. What are you doing in Brisbane? I had someone in my family bought there and they didn't make any money. And it's like, all right, well, what are you going to do, you know? We went and bought hundreds and hundreds. So it is what it is. And that turned out well. Now everyone comes to you from Sydney going, we need to buy Brisbane.
Now.
And they still do it because they're just like, you know,
that's a
the
very
bandwagon.
common thing at the moment.
It is, isn't it?
Sydney siders going, I need to buy in Brisbane. They're about like how many years late to the cycle. But we can still
Did
buy
they
in
mention the
markets.
Olympics by any chance?
Olympics
Always.
every day.
Always the Olympics.
Every day.
Why is that the most mentioned thing? I'm like, mate, that's not going to change.
I do find it funny because, like, surely I don't have the data on this, but would I put money on it? Depends how much. The infrastructure spend for the Olympics would probably be, I would guess, probably smaller than the Sydney Metro.
Oh, that I
Well,
don't know.
I don't know the figures.
I don't know
But
about
what I'm
that.
keen to know is...
I mean,
what I'm keen
that
to
was
see-
that was a guess because the City Metro has been going for like 12 years building it,
Yeah,
billions and billions and billions of dollars. Like,
Yeah.
I mean,
Well, exactly.
Yeah.
See what you just said there? That's great because you're just thinking. You're using your brain, essentially. You're saying, okay, there's no Olympics, there's no such banner, but look at Sydney Metro, what's being spent, and nobody's talking about it.
Well, it's- yeah, and it's just an
and people
everyday
are
spend.
oblivious to it. They don't look, actually, you know?
It's an everyday infrastructure spend, you
Yeah.
know, and especially when we go back to what we were talking about before with the fundamentals, and what we kind of touched on with with Darwin. So you got the metro, you got the M5 tunnel, you got this, you got that, which are just kind of routine, everyday infrastructure builds that have cost tens of billions of dollars, that have taken from a very tight labor pool of tradespeople. There's a reason why you're going to make more money if you're a tradesperson working on a government contract than if you are actually increasing supply. But these things we take it for granted. So to the point of like the 2032 Olympics, and not to focus on it, but with the 2032 Olympics, some of the bigger cities do have that infrastructure spend kind of just going
Baked in.
Baked in.
Yeah.
I'm keen to see how it impacts because I believe construction costs are going to rise. If someone can get paid more on an hourly rate, on a 2032 Olympic site,
100%.
they will go there over the standard resi, and the resi costs will continue tracking upwards, especially with what's going on currently in the climate. I think cost of construction in Queensland is going to considerably go up, and over the next few years, I think that in turn is going to drive that market as well as that low supply and high demand.
100%, especially what we highlighted earlier on the podcast, which is bake a few interest rate rises.
Yeah.
Construction companies and developers, their cost of doing business is higher. Then you've got the demand from the government coming in as well for higher margin work. And it's kind of the perfect storm for building resi properties in the southeast Queensland corridor, which, you know, it depends how you want to bake it in, but it can go all the way from the Sunshine Coast into northern New South Wales, right?
Yeah.
Like it's a big area. But to close us off, we've identified our growth market, Hung. How do we execute?
Oh, well, I don't know
Speak
how
to a
many
broker.
secrets Michael is going to
Speak to the broker
reveal
first.
here.
Speak to the broker first.
But yeah, obviously, you want to buy, you obviously need to understand what you can borrow, what capital is required, all the different options. I might throw it to Michael, actually. Interestingly enough, in a sense of people wanting to buy purely investment. Obviously, if they don't have a HtAG subscription, for instance, if they subscribe to that, they learn all the dynamics, the email chains I keep getting from Matt. It's there's a lot of good information there, things to learn. If you're constantly learning or looking through that, you'd educate yourself 100 times over what you do by just sitting there twiddling your thumbs or even just purely listening to podcasts. Puts a lot of good content out there, so that might be your first step if you're going to buy yourself, not rely on a buyer's agent. But if you are going to rely on a buyer's agent, obviously make sure it's a good one. I know a couple of good ones that will obviously come onto the show.
Let me know.
A 5-star review for Pinnacle.
Let me know who they are, by the way, please.
Mate, we're stars over here, mate. We're stars.
Stars. 5 of them, yeah.
Before you go, I just the interesting part, if you are going to buy yourself, right, without the buyer's agent, I'm actually curious to ask you this question is because I obviously work with a lot of buyers agents. I understand the process. I bought a lot of properties myself. It's a tough gig buying property, right?
It's getting harder.
If you have, if you don't actually know what you're doing, because you got to understand obviously your contracts, you got to understand, build relationships with the real estate agents. You got to understand what makes them tick. getting off market opportunities isn't simply just getting off market opportunities. You know, it's about the relationship, and they know that you can transact without making their life hard, right? All of these elements, people are just thinking, oh yeah, I'll just go realestate.com, buy a property.
That's well said.
But they're not looking at the property itself. They're not actually really looking at the intrinsic value. They just go on realestate.com, go bang, they've got one data set, and it says, oh, those data sets are often incorrect. Literally, every time I look at one, it's incorrect. Right? They're actually not seeing the pressure on the floor. So very difficult task to do by yourself. And I've done it by myself when I wanted to buy in the market. It took me 4 months to execute the first deal. That was 4 months.
And you know what you're doing as well. I consider you
that would have deserved a
I
one-star
actually
review.
knew what I was doing for 4 months. But once I hit the 4-month mark, it was funny. I bought 4 properties in about 4 weeks.
It happens that way.
Yeah, in that 4 months, it took me to build those relationships, work out the agents, work out every single property. And mate, I lost 4 months in the market. To me, I lost 8% or 2% per month market in that environment. Should have just went to buyer's agent in my case. But I guess my question
you know where to
is,
go next time.
like with all of these things, like how do you, when you enter a market, like, what do you do? Do you make relationships first? How does this process work?
I want to give some really good value on this. And it's one that a lot of buyers agents probably won't talk about, and I don't know who's doing it and who's not, but I think you need to qualify agents. Now, I haven't heard anyone talk about this before, but this is what I do.
Selling or buying?
When you're buying as the buyer's agent. So if you are an investor yourself, qualify agents.
Sales agents.
Sales agents. So literally call the whole list and ask them. Obviously, try and be somewhat charming. Don't be a pain in the ass. Make them like you.
That's why I'm not a buyer's agent.
No. People have to like you. So the way in which that works is, you call and you find the one that actually suits you.
Yeah.
So I will write them off based on their strategy. So if they're like, come to auction and then you can bid. Nah, I write them off. And then if it's like, we're going to do an open on Thursday, and then we're going to do an open on Saturday, and then you're going to give your multiple offer scenario. No, I write them off. I'll go down until I find the buyer's agent that's willing to play ball how I want, and that is, yes, off market. That's how I like to do my deals, whatever. I will build that rapport, let them know I'm experienced in the game. We review contracts. You mentioned contracts earlier. We'll review them ourselves quickly, right? So we come back with terms that are favorable. We ask, what they need, and make that deal happen. But qualifying agents is one that I think a lot of buyers agents aren't doing. A lot of the people in the investor space aren't doing. And you need to find the ones that are going to play ball, the ones that aren't too fussed on the top dollar, that aren't too fussed on taking you and putting you in a competitive environment against other BAs and other investors, because you need that advantage, and that advantage is how you get the off market. That's how you get the under market value deals, and that's how you win. So that's the best takeaway as far as how to find those off markets. Find the agent that's willing to play ball.
Now, on that note, I think that's all we have time for today with that amazing insight. Thank you so much for that, Michael. Now, that was Matt Djolic from HtAG and Michael Lezaja from Pinnacle Buyers Agents. Gentlemen, thank you so much for your time today.
This is really fun. Thank you guys for
having
inviting
us.
us. It's really cool.
And Hung, my co-host, as always. Thank you so much, and I hope you have a bit of a rest up after your, was it 48 hours? How did it take 48 hours to get back from the US?
I took a 30-minute flight from Austin to Houston, and then the plane got stuck in the air because of some cyclonic winds. I was up there for 7 hours sitting in that plane.
Just circling?
Yeah, just circling. And they ended up in Sydney. Obviously, my plane had taken off already to go to Sydney. So then they wouldn't pay for a hotel or anything. I'm like, what's going on? They go, it's not our fault. It's the wind. Anyway.
Yeah, but could they have landed somewhere else though? Not in Houston?
I'd love to say it's
Like
not my
town
fault,
next
it's the
door.
market.
Wow.
Look,
Man, I'll be like.
Were you at least
happened,
business class?
No, this because I was on a bucks trip, so we went.
You're in economy.
Cattle class.
That makes it worse.
You thought you'd be down with the boys?
Mate. Nah, never again. But anyways,
Just say, I missed my flight. You turn left as you get on the plane.
we're about to record again after this, so I'm going to do another quick record.
Now, that is all we have time for today on the How I Met My Broker podcast, and stay tuned because we'll be back at the same time next month. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.